Ares Capital Corporation is a business development company, otherwise shortened to BDC. BDCs are sort of the distant cousins of the REIT. They have a similar tax structure where, while not being taxed at the entity level, their dividends or distributions that they pay out to shareholders are taxed at the ordinary income level rather than the long-term capital gains level like a qualified dividend. Ares Capital generally, during most periods, has a pretty stable stock price, but pays out a pretty beefy distribution to its shareholders. During times of extreme market fear, you see the stock has hit levels that are substantially lower than normal, such as during the Great Financial Crisis and during the 2020 spring of the pandemic. What does this show you? Well, it shows you that during these times, these economic crunches, people, for some reason, worry a lot about the future of the BDC. Part of that is because they invest in largely the middle market type businesses. These are somewhere between your mom and pop little small business and your big Wall Street powerhouses. These are perhaps too small for an IPO, but too large to get their funding requirements met by, say, a branch at your local bank. So, what is a middle market company to do? Well, they've got venture capital and they've got BDCs. Those are kind of where they have to go. So BDCs, in a sense, give you access as an investor to companies where usually you would have to be a venture capitalist, an accredited investor, something like that, to even get your foot in the door on investing in this middle market segment, which a lot of people would refer to as the backbone of the so-called real economy. In fact, middle market companies make up about 48 million American jobs. They account for 1/3 of the whole U.S. economy. That's pretty crazy. So these companies tend to have revenue between roughly 10 million per year and 1 billion per year. I know that's a pretty wide range, but that's kind of about where the cutoff is. Now, middle market companies can be publicly traded, but BDCs usually focus on the privately held ones. But in the event that one that they are invested in has something like an IPO, a BDC can actually get a pretty big windfall from that. There was one that I think was invested in like Palantir or something before the IPO, and they paid out this ginormous special dividend from the money that they printed from that IPO. So windfalls like that are always a possibility. However, there's also the possibility that a recession or something like that hurts these middle market companies especially bad, and that can be some of the scary part of owning a BDC. So they were founded in 2004, and they like to keep a pretty good diversification of both industries and geographical locations. And that can be good because sometimes there can be issues just either with one particular industry getting hit by some kind of issue, or some type of region-related issue, especially if some of them are physical businesses. Things like natural disasters or state and local regulations can, foul things up for you in one specific place. So that kind of protects them to a certain extent from those types of things. However, broader overall economic issues can still, they can still be vulnerable there, right? Nobody's invincible. Now, when it comes to their track record, they have generated 70% higher stock-based total returns than the S&P 500 since their IPO. Careful. All right, I will tell you, track record for me is important, but if someone says, well, hey, we've beaten the S&P 500 over this specific period of time. Okay, that's good. And that says that, there's probably some validity to your business model, and it probably says some positive things about the company's management. But that you have done that in the past over a period of time doesn't mean that's going to be the case over the next, say, 10 years, 20 years, what have you, okay? That isn't how it works. You can beat the market up until you don't. And this is one reason why, like, say, Warren Buffett is so impressive, because he's beaten the market for like 100 years. No, just kidding, just 60. But you get my point. It's very unlikely that just because something has beaten the market over X period of time that it will do so in perpetuity. So don't necessarily expect that it's going to necessarily keep up its own previous level of performance. It's really all about the future, and granted, they may still beat the market, but I wouldn't necessarily expect it to be a 70% higher return, okay? They might still beat it, but it might be by a lot less, or they might just match it, or heck, they could even underperform at some point. That's something to keep in mind. This isn't a guarantee. Historical is not an indicator of future, all right? Now, when it comes to how I like to kind of evaluate BDCs, I generally like to look at the balance sheet. So Ares seems to mostly trade pretty darn close to its book value. What I like to do to get my initial, and this is what I did to get my initial shares going, I kind of just at different points sold cash secured puts slightly below the money, using both the fact that I sold it at a lower strike than the current stock price and collected some premium to effectively lower my cost basis a little bit to get kind of a deal. Okay. And it's not to say that I got like a huge discount. Like I didn't get like a 50% discount on its fair value or anything. Like maybe 10% or so at best discount. The only time you're going to get a really, really big discount on something like Ares, again, is these, big troughs during really, really, really fearful times. And during these times, it is going to be so hard seeing it drop like 60% or whatever and still like go, oh, well, this is a deal, and click the buy button, okay? That would be so hard to do. Only a very few people, I think, have the temperament to do that. But I think over the long haul, dividends reinvested, one could probably do worse than Ares Capital. I don't think they're going anywhere anytime soon. And frankly, BDCs are often compared to REITs. So this year, it's pretty well been flat. I mean, there's been some ups and downs, but small ones, small bumps, ups and downs. Okay. REITs look a lot worse than this right now. So if you had BDCs and REITs both in your portfolio at the beginning of 2023, the BDCs are basically propping the thing up right now while the REITs are taking a dump. Does that mean REITs are bad just because they're down recently? No. Does that mean BDCs are better than REITs because they haven't been hit yet? No. And, things could take a turn, and, if this, perceived recession economic situation does start to hit those middle market companies badly, all right, the way it might have done, again, during the financial crisis, during COVID, we could see another, bloody period for, oh man, that's phrasing, for BDCs, okay? It could be pretty bad if that happens. Brace for impact. But the last couple times it's happened, once we got out the other side, things came back. That's another thing to keep in mind, right? Now, that's not a guarantee that they would get out the other side unscathed, but that is just to show you that just because things look super grim doesn't necessarily mean you should panic, okay? If you can try to take your emotions out of it, you're more likely to come out with the more rational decision at the end. Okay? Easier said than done. But anyway, do you own any Ares Capital Corporation? I want you to let me know down in the comments below if you have this BDC in your portfolio. Let me know also what you think about BDCs overall. Do you like them? Do you avoid them? How do you value them? Do you do it based on the dividend? Do you do it based on the net asset value? How do you look at it? Let me know how you slice it and dice it. I'll talk to you later. Have a wonderful Manic Monday.